Everyone wants a piece of the Anthropic IPO. Almost none of them have thought about what a piece actually means. And, by the time most people figure it out, the price will have already told them. Here's why it's got this grip on people. Anthropic quietly filed confidential paperwork with the SEC on June 1, 2026, right after a funding round that pushed its valuation to roughly $965 billion. Some bankers think the actual debut could clear $1 trillion, making it the first AI company to walk onto the stock market already worth more than most of the S&P 500 combined, before a single retail investor gets to click buy. It took Apple about 40 years to reach $1 trillion. Anthropic is on pace to get there before its own product lineup turns 5. Numbers like that don't invite analysis, they invite a stampede, the kind that hits every Best Buy on Black Friday, except this time the doorbuster is a stock ticker, and the line forms on Wall Street, not a parking lot in Ohio. So here's what actually happens next, minus the hype. Right now Anthropic is private. The shares belong to employees, early investors, and the venture funds that got in years ago, back when this was a research lab, not a headline. A confidential filing means the company is doing paperwork with regulators, not opening a storefront. When the stock finally lists, likely as early as October, investment banks price the shares and hand the first allocation to institutions, the pension funds and mutual funds that already had a seat at the table. Retail investors, the people scrolling Robinhood on their lunch break, generally get to buy only after trading opens, at whatever price the institutions already decided was fair, which is a polite way of saying the good seats sold out before the doors opened. Sound familiar? It's basically Ticketmaster but for capitalism, and somebody's making a killing on the markup, and it isn't you. This is also why the IPO pop you hear about is a little misleading. When a stock jumps 30% on day one, that's not free money for everyone. It's usually proof the bank priced it too low for the institutions who bought early, and by the time it's trending online, that markup's already been collected by somebody who isn't watching your video. Facebook's IPO in 2012 did the opposite, opening big then spending over a year underwater, so even the direction of that first day pop isn't something you can bank on. It's worth pointing out this isn't hype built on nothing. Anthropic actually sells something people pay for. Claude Opus is the model a lot of software engineers use to write and debug code, a big chunk of the enterprise revenue driving that valuation. Claude Sonnet powers most of the everyday chatbot use you'd recognize. And the company recently pushed into creative and knowledge work with Claude Fable, aimed at writing and content generation rather than just code. There's a real product line behind the hype, which is more than you can say for a lot of companies that IPO on a good story alone. That doesn't mean the price is right. It just means the business underneath isn't fake. There's also a lockup period most people forget about. Even employees and early investors with real, legitimate shares typically can't sell them right away. Companies usually build in a lockup of 90 to 180 days after listing, specifically to stop the exact stampede everyone's expecting. So the insiders you'd assume are cashing out on day one are mostly stuck watching the ticker too. The only difference is their cost basis is a rounding error compared to yours. There's a darker wrinkle too, one nobody's putting in the thumbnail. Anthropic has publicly warned that certain platforms selling pre-IPO shares right now aren't authorized, and those trades won't be honored on the company's books. A handful of these marketplaces got called out by name earlier this year. So if someone in your group chat is hyping a way to buy in early, that offer is either indirect exposure through a legitimate fund or paper that may not survive a legal review, and nobody selling it is going to mention that on the way to your Cash App. Now, why does everyone want in this badly anyway? It's not really about the numbers. Wanting a piece of the company everybody's talking about is a social instinct wearing a financial costume. Behavioral economists call it anticipated regret, the fear of being the guy at Thanksgiving, explaining why he didn't buy the thing that made his brother-in-law rich. That fear beats discipline almost every time. It's the same current that pulled money into GameStop and Dogecoin, except this one's wearing a suit and has an actual balance sheet, which makes it feel a lot more rational than it probably is. Nobody FOMOs into their Roth IRA contribution. People only FOMO into the thing that might make them look like a genius at a barbecue. Remember Rivian back in 2021, the electric truck company that IPO'd at a valuation bigger than Ford before it had shipped a couple thousand vehicles. Everyone wanted in, because Tesla had already made early believers rich, and nobody wanted to miss the sequel. The stock lost about 90% of its value over the following year. The company's still around and still making trucks, so the story wasn't wrong, exactly. The timing and the price were. And that's where the story splits from what tends to actually happen. The pitch is simple: get in early, ride the growth, this is the next NVIDIA. What usually happens with hyped debuts is messier. $1 trillion valuation before day one means the market has already priced in years of flawless execution before the opening bell even rings. If growth slows even a little, or Google or OpenAI close the gap, that valuation has a long way to fall, further than a company priced with a little more humility. One finance professor watching this wave of AI listings compared the mood to the final stretch before the dot-com crash, when companies with barely any revenue were valued like they'd already won. History doesn't repeat exactly. It just likes to rhyme, usually right before the part nobody wants to hear. Zoom out and this stops being a story about one company. Anthropic is one of at least $3 trillion scale companies expected to list around the same window, alongside OpenAI and SpaceX. When that much capital tries to squeeze through the market's door in a matter of months, it's a test of how much blind faith an entire economy is willing to put behind one technology, all at once, with real money, in public. If even one of these three stumbles out of the gate, it becomes a headline that spooks every retail investor who bought in on vibes alone, which, if we're honest, is most of them. There's a reason regulators care about this too, beyond just protecting people from bad math. The SEC's entire disclosure process exists because private markets don't have to explain themselves the way public ones do. As a private company, Anthropic could raise money from institutions who do their own deep research, sign their own agreements, and accept the risk with open eyes. The second it goes public, the company is legally required to tell everyone, including someone buying 10 shares on their phone, the same information. That's a real shift in obligation, and it's part of why these filings take months to clear, even for a company moving as fast as this one. It's also worth asking who benefits most from a huge IPO happening right now, in this exact window. Venture funds that invested years ago need what's called an exit, a way to turn paper gains into real, spendable cash. An IPO is one of the cleanest exits there is. So some of the enthusiasm driving the timeline isn't really about Anthropic's product roadmap. It's about early investors wanting liquidity, while the AI story is still the hottest thing in the market. None of that makes the company less real. It just means the timing of the IPO serves some people's interests more directly than others, and retail investors usually aren't in that first group. There's also the competitive angle worth sitting with for a second. OpenAI is reportedly circling a similar filing window, and SpaceX just filed for what could be the largest IPO in history, reportedly selling shares at $135 each. When three companies of this size try to go public in roughly the same stretch of months, institutional money has to make choices about where it actually goes. Not every fund can max out its position in all three. So part of what happens over the next several months is investors quietly picking a favorite. And that competition for capital could easily move each company's price more than anything happening inside their own walls. It's a little like 3 blockbuster movies all opening the same weekend. The box office doesn't triple just because there are 3 big releases. It gets split, sometimes unevenly, and the one that underdelivers gets talked about a lot more than the ones that just did fine. There's one more wrinkle that rarely makes it into the excitement. Once Anthropic is public, its stock price becomes a daily referendum on something that's genuinely hard to measure: how much of the economy AI actually ends up running. Every earnings call becomes a test not just of revenue, but of whether the story investors bought into is still believable at the price they paid for it. That's a very different kind of pressure than a private company answering to a small group of investors who already understand the roadmap. Public markets are less patient, and they update their opinion in real time every single trading day. And here's the thing, nobody says out loud on Finance YouTube. Most people watching this video are not going to get meaningful access to this IPO at the price that matters. Not because the system is rigged against you specifically, but because that's just how the mechanism has worked for decades, going back long before AI was even a category. The interesting question was never really, how do I get in on day one? It's whether you're comfortable owning this business 2 or 3 years from now, at whatever price the market eventually settles on, once the hype has had time to either prove itself or fall apart. None of this means don't buy it. It means know exactly what you're buying. A business, at a price that reflects what it can realistically deliver. Or a feeling, dressed up as an investment, that you didn't miss the moment everyone was talking about. Those two things can look identical on your brokerage app. They do not look identical 5 years later. So ask yourself honestly, when the ticker starts moving, are you buying the company, or are you buying the fear of being the only one who didn't? Only one of those tends to make you money. The other just makes for a good excuse at Thanksgiving, right after the green bean casserole, and right before someone asks how your 401k is doing. That's where I'll leave this one. If it made you think twice, that was the point. See you in the next one.